Welcome, everyone, to Willow Oak's 2022 Investment Panel. We're so delighted to once again be in person, seeing old friends, not behind a computer screen, and meeting new ones as we grow the Willow Oak network. We're so happy each of you could join us today, and what a day it's been. For those of you that I've not had the pleasure of connecting with directly yet, I'm Jessica Greer. I lead Willow Oak and have the pleasure of working with our distinguished panelists through Willow Oak's fund management services. Like our managers, we believe in finding and investing in quality businesses, and we believe having skin in the game is a key component to success. With that in mind, we partner with our affiliated managers to reinforce the strength of their investment process by building and managing effective and reliable operational infrastructure and marketing strategies that support their growth. From investor relations to compliance to bookkeeping to business administration and beyond, we handle everything outside of the portfolio so these guys can stay focused on what they do best, finding great investment opportunities. And because I wear that compliance hat, I must say the information contained in this panel is of a general nature and is provided for investor education only. No comments constitute investment advice or sales. And now, before I hand things over to Andrew, I'd like to take a moment to thank our fabulous operations team for all they do and for making this event possible. I see Aaliyah Kleinhammer in the back, and I think my other two colleagues, Elisa Sanchez and Steve Eisen, are still trying to get people to come inside. So thank you to you guys. And now, some quick introductions to the gentlemen to my left who need little introduction. I'll start with Shree Viswanathan. He focuses on compounders and special situations across global markets. Deploying a comprehensive discovery and research process, Shree is committed to finding quality companies led by exceptional owner-operators who are generating healthy returns and reinvestment opportunities, all at a reasonable valuation. His experience includes working as an M&A banker in an investment bank, a corporate development executive in a commercial bank, and a portfolio manager. Shree founded SVN Capital Fund in 2020 and has managed capital through separately managed accounts since 2018. Geoff Gannon and Andrew Kuhn launched Focus Compounding in 2017, offering investment research and write-ups through their website and subscription services. They took the investment podcast center stage in 2018 and have released more than 354 episodes, reaching countless viewers worldwide. Their tremendous following speaks for itself. Today, Geoff and Andrew offer investors access to select portfolios of overlooked securities through a private partnership and managed accounts. Keith Smith manages Bonhoeffer Capital, where he looks across global markets for misfit businesses. Making sense of companies that are mispriced, mischaracterized, disrupted, consolidating, or going through corporate actions makes for a particularly unique portfolio. Keith has served as an Air Force captain and has nearly 30 years of experience as a valuation expert, all leading him to put his investment acumen to work for outside investors, co-founding Bonhoeffer Capital with Willow Oak in 2017. And last but not least, Steve Kiel is the founder and portfolio manager of Arquitos Capital, where he focuses primarily on finding and taking concentrated positions in special situations. Looking for asymmetric opportunities to arbitrage, Steve's background as the CEO of a publicly traded company, a recovering attorney, and a retired major in the U.S. Army Reserves brings an unconventional perspective, blending a traditional analysis approach with the mindset of an entrepreneur. Steve founded Arquitos in 2012. Thank you so much, gentlemen, for being with us. And now I'll hand it over to Andrew for the main show.
All right. Any first-time Berkshire goers this year? Wow, look at that. Very cool. It was Geoff and it was our first time as well. Before we talk about fundamental value investing, I wanted to go over some things that have happened since the last in-person Berkshire meeting 3 years ago. Things that literally started and ended within 3 years. I mean, Geoff and I were kind of laughing about this. Remember when we were having fun, staying poor, while YOLO traders with diamond hands pumped meme stocks going to the moon? Yeah, exactly.
That's right.
Remember when that guy who started a popular sports blog was on CNBC saying that Buffett was washed up as he was picking out Scrabble letters to decide which stocks to buy next because stocks only go up? Remember when there were around 1,000 SPACs created, making billions of dollars for their shareholders? I mean, promoters. And then finally, this is my favorite. Remember when a popular movie theater company that was founded in 1920 decided to diversify their movie theater business by buying a 22% stake in a gold miner? It's been a great time since the last Berkshire meeting. So on that positive note, as we talk about fundamental value investing, I want to turn it over to you guys to first start and kind of get everyone's first takeaways, thoughts of the Berkshire meeting. And I'll start with you, Shree.
Thanks, Andrew. It's always a pleasure to be here. This is probably the 7th or the 8th time I'm coming to Omaha. It was a fantastic show today, and so many lessons about long-term, about patience, about compounding, and how not to get carried away with Bitcoin and a few others. I thoroughly enjoyed it.
Geoff?
So it has been a little surreal for me. I don't know that I appreciated how much of an experience it is here. We came over on a flight that was probably from Dallas to Omaha. That was just about everybody that, there's almost no one who was just going to Omaha for anything normal. It was all for this. It's more of a religious experience than communal experience than I realized.
Pilgrimage.
Any thoughts on the meeting? Warren and Charlie?
Yeah, I mean, Warren said something about where he showed the illusion, the optical illusion thing, which is something that I thought was really interesting and something that relates to what you talked about, what's happened the last few years. Two different ways of looking at something, two different ways of looking at markets,
Keith?
Yeah, so I mean, I've been going to the Berkshire meeting probably for about 10 to 12 years, and this is it's great to be back. I've always enjoyed these meetings, as you guys have. You get not only the meeting, but the side meetings like this and other places just to meet investors. The things that really struck me, which I think is sort of a different way of thinking about when Buffett answered the question, was how can you fight inflation? His response was get better skills, which I think is it's more of like developing your personal capital. And for folks here, especially the folks that are younger, just sort of starting out maybe in their 20s and 30s, that's probably the best advice you can get, because once you have those skills, it's sort of an independent of investing sort of approach, but I think it's really good just for everybody, because that's companies are always going to need people, and as long as you can keep those skills up, develop better skills, it's something that really will, because inflation is difficult to invest. It's a difficult time to invest typically if you're going to have longer term inflation. So I thought that was a really good advice. The other thing that I noted, which I think makes a lot of sense, and I think all of us have sort of experienced this, is be prepared. In other words, if you've got a specific group of industries or companies that you're looking at, and be prepared to take advantage when situations which nobody expects to happen will happen. But the only way you really can effectively have confidence to put money to work is to have to do the work beforehand. And so you can, when a crisis happens that no one expects, if you focused or have an expertise or have some information about a specific company or industry, you can feel confident in basically taking advantage of that and focus on some of the other things as opposed to getting up to speed really quick, which can be, there's some dangers with that. But those are the two things that he had spoken about, I think, that hit me the most.
Buffett's talked about that for years too, that he bought into a company and said, well, I've been reading their annual reports for 25, 30, 50 years sometimes. And he invested in year 51, which is kind of crazy, right? You're reading all of these annual reports and 10Ks for a lifetime, and you have that much patience. And, first of all, you have to find that interesting, right? You don't want to read through all these things out of boredom, but it does go to show just how much value you can get out, how much understanding you can get out of reading the 10Ks themselves. Put the Bloomberg away, read the 10K, and if you find it interesting, that's where you kind of get those connections and that pattern recognition and things like that, and have the patience.
Patience,
well.
Yeah, the last Amex purchase was 1998.
Yeah.
That was amazing.
Well, I mean, the other thing, too, I think, working off what Steve was saying there is, one thing that I found useful for investments is pick an area of interest that you really have a passion for and study the businesses and industries in that. And then what you can do, that'll start out, let's say, your circle of competence, and then you can build it out from there, maybe finding similar business models, similar companies that may be in adjacencies to the industry you're in. But it's sort of, in my experience, it's been more of a building blocks kind of thing. That way you don't get overwhelmed by all the information, but you can focus on a specific area that's of real interest to you, and it's a passion for you, and I think that will drive sort of how you really think about and invest. And so I think, because the market has, I think there's a huge advantage for being a specialist in a market, because you're competing with a lot of the funds that have a lot more generalists, and they're not going to have the detailed information you can have. But if you can be a specialist in certain areas, I think that adds a lot of help.
As a generalist, I'm offended by that. But
no, that's right. No. but you've done this. No, I know.
Find your niche, though.
Exactly,
is for sure. And at that point, I do want to thank everyone on here, because my role, so I run a fund called Arquitos Capital, and we control Enterprise Diversified, which Willow Oak is a subsidiary of. And so I think I'm grateful. I think that my niche is to be able to identify talented investors and really just good people. And so I want to thank everyone up here, our staff that Jessica mentioned as well. And some of the fund managers up here, we share ideas, we talk through things, we get along, very well, and we all have a little bit of a different expertise as well. And if there's advice out there for others or for people just coming up, or even in their career, building that network is, for me, the most valuable thing I've ever done in my life, and I think has been the key to kind of success in the fund.
Definitely. So, given the crazy run in the market over the past couple of years, we're now at the point where the Fed is raising interest rates. They're signaling that they're going to raise interest rates more. We have inflation that is, here, and everything going on with that. We have the issue that's going on overseas. I'm just kind of curious to hear about, because there are a lot of portfolio managers in the audience, or private investors themselves, how you guys are just kind of thinking through the current environment in your investing process. I'll start with Shree, just because you're closer.
Yeah, inflation is an important issue, but I was just discussing this with a couple of people right before the thing started. It's one thing to think about inflation impact in the short term, but my approach to investing is fairly long term. Long term is north of 7+ years, and it's kind of difficult to contemplate the impact of interest rate moving over that time period. And also the type of businesses that I'm interested in. The type of businesses that I'm invested in and interested in are generally high cash flowing businesses, and not just high returns, but also high rate.
Give us an example.
You hear me? Yeah.
Yeah.
So
Give us a stock, Shree.
So I was actually right here in this room yesterday, and I was talking about a Polish food retailer that generates high returns and reinvests 100% of the free cash back into the business. Of course, it's Poland, so Andrew, I know you'll pick me again as far as a non-U.S. investment is concerned. But here's a business that's right in the close proximity of where the war is, and that's putting a lot of social service pressure, and as a result, inflation is running up. It's almost 10% in Poland right now. But the business is food retail. People still have to eat. There are more than 3 million Ukrainians that have landed in Poland. We don't know how many are going to stay back. But food retail is one business where they will, and they do, this particular company does pass on the cost. And it's evident in its same-store sales numbers. And those are the types of businesses. So inflation is an important item. But in fact, Geoff has talked about this in one of his podcasts, and I'll lead it to you, Geoff. The quality of a business can be determined by going from top to bottom of the income statement. And what he meant there was gross margin. These are businesses that have terrific gross margins, and even if inflation and interest rates do go up, the eventual outcome is going to be much better than investing in commodity businesses with much lower gross margins where inflation will have severe impact. With that, that's a good segue to you, Geoff.
Yeah, so what worries me the most, I guess, is that people haven't had experience with inflation or with interest rates rising as rapidly as they're likely to. We talked to a CEO of a bank quite a while ago before interest rates started rising, and one of my questions was, you're however old he is, 40-something or whatever, you've never had to run a bank when, rates have been falling basically the whole time you've been running this bank. Do you think that has something to do with your success? And is it how would it be if you were running things in a different environment? And I think intellectually you can understand that, but I don't think any of us can understand what it would really be like to be back in the environment there was from the late 60s to the early 80s or something like that. And I think some people will be surprised by what happens. It'll shift what businesses look really attractive. Because, we've talked about like See's Candies. Everyone says how great a business is and everything. But if it had been in the world of the inflation we had in the 2010s, it would have been a good investment, but it wouldn't have been the world-beating investment that we all think of it as because it has such good pricing power in the world of inflation. So it's going to shift what the great companies are depending on that, and it may surprise some people.
So what recommendation would you give to people like in their investing process with that thought process?
Honestly, yeah. So read things from 100 years ago, read things from 50 years ago, like that are contemporary of that period. You just read a lot of stuff that was actually from the 1970s and what they were thinking about. And it's a whole different world about how they were thinking. I remember hearing someone talking about how easy Ben Graham had it, and going over the years, and I thought a couple world wars, Cold War with atomic weapons for the first time, all the different problems. The stock market was closed for months when he had started investing, because of World War I. And it seems in retrospect, those were the easy, everything, was very placid then. And now everything, it's all happening fast and whatever. But actually, there's always been things like this. It was just, you have to learn about it from that period, not through the framework that you have now. What you learned for the last decade or something, it applies. Some of it is permanent stuff, but some of it is also temporary stuff. And so far, you won't have figured out what's the stuff that's forever and what's the stuff that worked while you were doing it right now and won't work in other decades.
Sure.
No, I agree 100%. And I guess I'm probably the older person on here that actually remembers the inflation days that I was actually around. You guys probably may have not been born yet, so it's like, but back then, the key thing with inflation, if you just take a look at industries, the industries that have done well was primarily energy and real estate, and right now, there's a huge aversion to energy. And it's just, we're in a little bit of a different situation now with energy because you have sort of this displacement with some of the renewable stuff. Historically, energy's sort of been, it hasn't, there's been a longer term idea of replacement, but it really hasn't been that much in terms of a threat. So things have changed, but I think the one thing is looking at higher interest rates. And I think a trend that's probably going to continue on is that interest rates will continue to be lower than inflation because the governments have to pay off this debt, and that's the way they monetize the debts. And so when that happens, you know, I think it's more of a longer term trend. And when you think about the types of businesses that do well in inflation versus not, that's another thing, because we've had such a long period of time, and financials are a perfect example of where you've just had a declining interest rate and you've just had this tailwind. If inflation and interest rates pop back up, a lot of that reverses, but there are some types of investments that financial institutions have that they may not have had as much back in the 70s, like floating rate debt. A lot of the issues of in the 70s where banks got into problems was they had long-term fixed rate sort of assets. And then when interest rates went up, the assets went down and the liabilities were variable, and so that led to that. I think there's probably less of that now because a lot of the stuff's floating. But I think it's a good thing to sort of look at is, okay, well, what's going on with inflation? I think another difference now is I think a lot of the deflation that we've been experiencing has been accelerated due to the fact that we're dependent upon China for a lot of the lower cost goods and services, goods primarily, that we've been going on. And I think what may be happening is the more China is uncertain and the more unstable China is, I think that we'll probably end up getting more inflation from that perspective. I've historically been very much a bull on deflation. What sort of caused me to rethink part of that is this whole China and how China has really created a lot of deflation around the world. And now with the uncertainty of just the situation in China, whereas before they appeared to be moving more towards, you know, a Western way of doing things, and now they seem to be retracing that back a little bit. What could that really do if all of a sudden the supply chains in China, or even, for example, the way that they're dealing with COVID now by closing down whole cities? Now, you may think, okay, that only affects the cities, but China has very integrated supply chains. So if one city or region has a key component for another, let's say an automobile or some other assembly, the whole thing gets shut down. And I think there's incentives there and so I think that's what makes it, I think, different than it is in the past. In my opinion, if China gets back to the trend that they were on, I don't think inflation is going to be as much of a problem. But if it continues to move in the direction that it is now, it could become a very significant issue, I think. So, I mean, those are some of the things I think that are important and it is different, whereas before, when we went through high inflation, China and Russia weren't even part of the equation. It was just dealing with the Western Europes because they were sort of doing they really weren't providing much supply to the market. And part of what caused the inflation in the 70s was the lack of the supply of the Western countries basically providing supply. There was demand, but the supply wasn't there. So the one thing to look at inflation is take a look at supply, because I think supply is what drives inflation. And I see the real sort of critical aspect of that in our current day is what's going to go on with China. And it's an interesting thing. In terms of specific businesses to look at, one theme that I've sort of, that I think is an interesting theme that will continue to do independent of what goes on with the economy and even growth rates is consolidation. And a lot of businesses you're seeing companies consolidating within industries. And I think the advantage of that is there's some dangers. The upside of that is you can get growth outside of industry growth through the consolidation process. The danger in that is people can make stupid acquisitions, or you need to ensure that management has a decent process and is very disciplined, because one of the areas that can destroy a consolidation process or an M&A acquisition process is by paying too much. And they have to have a really well thought out process. So I think that's one particular area that folks can look at is consolidation, because that can have...
Yeah, what do you think of, I mean, you're kind of a telecommunications expert, the Discovery, Warner Media, and other consolidation within the telecommunications sector?
Yeah, I mean, content's a tough one. And historically, I think in the communications sector, if we go back in time, we take a look at, okay, when media was basically just the three big networks, and there were constantly new people coming in and disrupting the market. So back in the 70s and 80s, when all this inflation was back in that time frame, you had the big three networks. And then cable came in, and cable became the new disrupting force. And you had individual channels like HBO that were pay-only channels. And then now you've got streaming sort of going through that transition. And so what you'll see from a consolidation perspective is each specific type of technology fragments the market further. And then what subsequently happens is there's some consolidation back. And it's really interesting looking at, okay, and you'll see this in the markets too, is a lot of times the disruptor will be priced way up here and all the legacy guys will be priced way down here. The real question you need to ask is, can the legacy players adopt the innovation that the new player has? And that's where I think there's a lot of opportunities, because across media, across a lot of different industries, if you sit down and you say, okay, well, I think these incumbents can really adopt this innovation, they have a huge advantage because they have all the customers. The disruptor is at a real disadvantage, and the way they can really take advantage is if there's a complete change in the value chain. So you have to take a look at not only the industry, but who is supplying them and who is their customers. And if the value chain gets totally rearranged, that's where the disruptor has a huge advantage.
So is Netflix considered a disruptor, or are they now considered legacy?
I would say that since a lot of other people can do it, they definitely have an advantage in streaming. The real question in my mind is, okay, streaming is one part of the bigger media industry, and when you look at these businesses that are sort of focused on that, where basically they make the money in streaming, you look at all their competitors, like for example, look at Disney. So when somebody makes a piece of content, Netflix at this point is only monetizing it via their subscription. Well, when Disney makes a piece of content, where are they monetizing it? They're monetizing it in theaters, subscription. They have all these other channels to basically monetize this, so that puts them at a big advantage today. So I think the bigger, broader question you need to ask in the content space is, if you just focus on streaming, Netflix looks like they're the winner, but the content space is bigger than that. And it's interesting because in the media space, what people have realized is that there is technological innovation, but people are people of habit. And since people's habits continue on, legacy assets in those particular areas last longer. And you can probably see it even in generational, right? I mean, you still have large audiences for broadcast TV. And who are those folks? Those are probably folks in the 50s, 60s, 70s. Streaming is really popular with young folks, right? And so I think you see a lot of legacy carryover, and the folks in the media industry have noticed that even back when there was a transition from the big networks to cable. A lot of people in the industry were really surprised at how long the tail was of primarily the network broadcasts when the cable industry came. So I think there's some real interesting opportunities, especially when the market seems to be pricing these assets at large differences. Now, if Netflix price was close to, let's say, like a Warner Brothers Discovery, then you could say, okay, maybe I'll go with Netflix because it has higher growth. But when you mix it all together and there's such large pricing discrepancies, I think there's some interesting opportunities there.
Stephen, any thoughts on the current market, current environment, inflation?
Yeah, I mean, I think it's no secret that the solution from the investing side with inflation is to find companies with pricing power and, you know, other real estate related things. Like the question is, what are the specifics? You know, what companies specifically are the best there? I own a company called St. Joe's, which I think is interesting from a real estate perspective for a lot of different reasons. Demographically, you know, COVID stuff has probably accelerated some things there as well. But the most interesting part is, you know, they already own all their land. So they're not out there needing to acquire land over time. So if inflation lasts for a while, which it's, you know, right now it looks like it probably will, they don't have those cost pressures that other kind of home builders and other related companies have. And they're kind of at an inflection point right now. So St. Joe's is interesting to look at. You've got a lot of people relocating to the areas where they're building, and they've got a prudent capital allocation strategy. So that's a company I like. You know, other things like that. You know, it's tough. You don't want the entire portfolio to be based on kind of macro-related themes. You want to find great companies that are going to do well under any environment, whether there's an inflationary environment or not. But I think at this point it's more interesting to kind of skew the portfolio into things like real estate and things that that have that pricing power, whatever they might be. I'm not sure if the telecommunications and some of the media companies, I mean, we'll see how much pricing power they have. How much can Netflix kind of continue to raise prices during this time? How much are content costs going to go up? We don't really have a model from the 70s to take for a company like that.
I mean, the one note on content is historically the content business has been very capital intensive, and people have lit content on fire because people will make content for non-economic reasons, for more ego reasons. And my observation about the media companies is they've invested just enough to prevent churn of eyeballs. No one's ever gone out and said whenever anyone's gone out and said they're going to spend all this money on content, it's turned out to be a disaster because I think it's just the nature of content. You can spend a lot of money, but you're not going to get that much more advertisers. You have a limited amount of people, so it's tough to, I think, compress what takes a long period of time for people to get attached to content and for the resulting them watching and the advertising pay for that. I think the more you spend on it isn't going to turn into more money you're going to get in terms of additional advertising and other subscription services.
Tangentially, and then we can probably move on to another subject here, but tangentially, I was listening to an interview from earlier today of the See's Candy CEO, and I think it lends to the idea that we have to be very careful in this environment as stock pickers. Most of the interview was, look, we hedge, we have long-term contracts on most of the raw materials that go into the candy, and then at some point at the very end of the interview they said, okay, but so he's like, well, we're more insulated than other companies, we're more insulated than other competitors and elsewhere. And they say, okay, but how much have your costs gone up year over year? And he said, well, we think we're in good shape. They've only gone up 15 to 20%. It's huge. It's huge. And do they have the pricing power to pass that along? I don't know. We'll see. And I think as stock pickers, we might want to wait and see in some instances.
So on that, as stock pickers, since the beginning of really the end of Q3, Q4 of last year, and then into this year to date, there's been a huge sell-off of anything tech related. I remember, at the beginning of the year, I was listening to a venture capitalist talk, and he was saying that even in the private markets, towards the middle of last year, they were raising capital at 100 times annual recurring revenue, and that has stopped. So I'm curious, as stock pickers, how is it for you guys looking for value in the market where, yes, there's been a huge sell-off in tech, but here we are today where the market's down basically 13.5%, something like that? I mean, do you find that challenging? Because do you ever feel like you look at a company and on the chart it may look like it's cheap compared to its past, but then you actually value it and you're like, I don't know, I mean, this doesn't seem so cheap. Shree?
Yeah, valuations have definitely been challenging over the last, I go back, more than just the last few months. But that's probably where my global approach helps a little bit, and the focus on quality helps a little bit. Of course, right now, it doesn't matter whether it's quality or not. Everything has been getting hit. But I've been able to avoid some of these major blow-ups. Many of these techs that have had a massive drawdown, they've generally been cash burning, unprofitable. I generally use this comment that Winston Churchill made many years ago. The farther back you look, the farther forward you'll be able to see. So I look back at least 10 plus years to get confidence that through various different price points and cycles, the company has been able to perform well. I will still be wrong in certain instances, but at least it gives me confidence that the performance has been fairly strong, capital structure has been fairly steady, and pricing power, as Steve mentioned, has been maintained over a long stretch of time. I get that confidence by looking at gross margin and the type of ownership interest and things like that. So while it has been challenging, I've been able to dodge a few. Right now it feels like I haven't on a couple of different names, but I feel like these are long-term holdings and only time will tell.
Yeah, to your point, when there's an I don't know, I mean, it's simple, right? And I don't know is a no. Don't do it. But it's not easy. This is where things are, investing really is simple but not easy. And the simple answer is yes, if you're unsure, then don't invest in it. The part that's not easy is you fooling yourself about what you know or don't know. So if you can say, I don't know, obviously you're going to pass on it, but you think you know more than you do, generally.
Yeah. I mean, another way to sort of look at sort of this tech crash, another way to sort of characterize it, I think you could sort of say is the disruptors have really fallen down, and the incumbent guys have maybe not gone down as much. And so if you look at it from that perspective, I think it's an interesting way, because these companies, what they describe as tech, if you look at the underlying businesses, they're not really, I guess, what you would call traditional tech. I mean, what traditional tech to me is like computer hardware and software, networking equipment. But Google really is an advertising company, right? Facebook is more of a media company. So these companies they've disrupted traditional media businesses. And if you look at them like that, I think it provides sort of a different kind of a framework, and then at least provides you a framework to compare these things to say, okay, we've got a legacy media business, compare it to Google, and to sort of take a look at it. So you're comparing, I guess, common industries, just a disruptor in industry as opposed to a totally separate business of hardware and software. At least that's just one observation, that a lot of these companies, a lot of times people sort of include tech things that aren't necessarily, I guess, what I would traditionally call as tech, but that's...
Yeah, I mean, and Geoff, what do you think, going back to the history, the 70s and other inflationary time periods, kind of to Keith's discussion, what is your takeaway from that?
My takeaway is the market's down a bunch, but it's not cheap. If you had told people were using 10-year yields and things like that to justify valuations, and now those yields have changed and people haven't adjusted the valuations to say it has to be more in line with what it was in the past. I think it can move a lot more than people think, but it tends not to move that much that quickly. It takes a long time for people's expectations to change and for a whole shift in how they value things. Because, people made a lot of money in these stocks. So if they drop in half, people are going to see this as an opportunity to buy them again and do it again. But there's some point where time will wear people out in that, and valuations will change.
So I picked on SPACs in my opener, but one good thing about SPACs is that it brought a lot more companies public. I'm curious if any of you have spent any time in busted SPACs or SPACs to look for any interesting opportunities.
Zero.
Geoff?
I've looked at them. We don't like to invest with people we don't trust and stuff, and a large number of them are more promotional.
So zero.
Eventually, the other people will be involved. Look, management will churn and stuff, and eventually there's some legitimate companies, and sometime there'll be the right management running them.
I've looked at them, but the ones that seem to be the good ones are priced that way, at least in my opinion. So, there are some good SPACs out there. They're definitely in the minority, but being a value investor, they were priced, at least at this point, too high for me to really be interested.
I'm going to say I'm kind of exhausted by the whole SPAC discussion from the last few years. But, I wish there would have been a question maybe to Buffett about Chamath.
Yeah. I'd be curious to hear, through COVID, the investing, your experience. From the perspective of, have you changed anything about your investing process? Is there anything that you will, when you're underwriting a company, sort of think through going forward? Any sort of takeaways as it relates to being an investor?
As an investor, I'm always evolving. I don't want to be rigid in how I think about the opportunity set. I have to be able to accept what the market is giving me, and I'm not saying I should change the stripe of my back every other day, but I have to be willing to accept what the market is giving. And so in that regard, I'd say I've been more evolving over the last 2+ years. but I haven't changed the approach to how I think about the actual capital being deployed. It's simple. I keep it simple. I ask 4 questions and I look for possible answers on all 4. Do I know the business? Is it a high quality business? Quality defined both qualitatively through competitive analysis and quantitatively through capital structure, returns, reinvestment. Is it run by good quality management team with skin in the game? And is it available at a reasonable valuation? So those 4 questions have remained consistent. But in the process, the movement of the market through certain sectors, certain industries, that has been, I've remained a little bit more flexible.
Geoff?
No, I haven't learned anything. Haven't evolved.
Haven't evolved. All right. He's always honest. All right. Keith?
No, I mean, I think what it's done for me is through this COVID, what it really has highlighted, I think, is the difference between disruptors and disrupted companies, because of the way that we've done stuff has changed over time. And in my mind, my process has evolved to really include what's the trade-off there, and has the market gone way towards one way versus the other. If you look at incumbents versus disrupted companies, what's that sort of trade-off? And that whole, I think, dynamic before COVID was happening, but maybe it was happening at a slower pace. And what COVID really did is it accelerated the pace of that change, so you could see it in your face. You could see, okay, well, the disruptors were valued at huge high prices and all the incumbents were it reminded me a lot, the same thing happened in the dot-com era too, right, back in 2000, where you had this huge divergence between old economy companies and then the dot-coms. I mean, actually, Rob Robati had a great headline of a conference I was early today. His sort of title, which I think really makes a lot of sense, Revenge of the Old Economy Companies, right? I mean, which is sort of what we may be experiencing here, because people get so excited about this new innovation and they price it way up. And now we're sort of in the process of figuring out where's it going to be long term. So you get overshoot up and overshoot down. And as stuff continues to adjust here, there's probably going to be an undershoot in terms of these disruptors being way undervalued. So, but that's part of the process of sort of incorporating these things into the market.
I think the philosophy has stayed the same, and probably that's the case for all of us. And it's the application and strategy where you maybe have to be a little bit more nimble in your thoughts, because there is a change in terms of the amount of information out there. One of my kind of criteria is I do kind of an arbitrage approach. It's time, emotion, and information. And historically, that information arbitrage was, look, especially for smaller companies, you might know more than others. You know, going to talk to the company, going to the annual meeting, doing some cursory due diligence gives you a huge advantage over many investors in smaller companies. And that's still true, but on the other hand, there's such information overload that you can have a massive advantage simply by knowing which information is more pertinent or more important, and not be overloaded kind of with information. I mean, today we live in a society that's the bigger risk. I think having a lot of irrelevant information. You have to be very careful about your data sources. So I think you can apply that to a lot of things during COVID and the misinformation involved and the lack of trust, not just from the government, but where that information comes from across the board.
How many people in here are on FinTwit, Finance Twitter? Yeah, good amount. It's a great platform. I'm curious, we have the whole thing going on with Elon Musk and Twitter. And I'm curious on your thoughts on the trend of boards having less skin in the game. And maybe, Stephen, you're probably one of the best people to ask about with your board experience.
Forget about the money and the lack of investment that they have. None of them even tweet.
Yeah.
I mean, I don't think they're even counted in the daily user or the monthly user count. So it's really ridiculous that you have these kind of decision makers at a company that really don't even understand or don't use the product. You know, imagine the Coca-Cola board of directors not drinking Coke, right?
Yeah.
Or imagine a bunch of the board of director of Ford, you know, driving Chevys or something like that, or not driving at all. So it's a little bit odd, and that's kind of the maybe historical anomaly that is Twitter. And I don't think it's a new, I mean, Twitter is a great example of that, and it highlights the really egregiousness of it. But, you know, this goes back, there's a lot of companies like this, a lot of companies where the board members are not really investors themselves, they're not skilled at capital allocation, they might not have skin in the game, and I think that's probably the norm more than anything else. And, you know, that's why you gotta love people like Carl Icahn.
Keith?
Yeah, I mean, I think the thing with Twitter, it's interesting when you think about it. Part of the thing with Twitter is the user value is tremendous for the people that actually use it. The consumer surplus in Twitter is huge. And what they haven't done is done a good job at monetization, right? Versus you still get consumer surplus, I think, in other types of social media platforms, let's say Facebook, but there's much higher monetization in those. And it's interesting to think, all the people that I know like Twitter because there is not that much monetization, because as they monetize stuff more, your consumer surplus goes away. So there's an interesting balance there. The Twitter hasn't done mass monetization, but if it does, it becomes almost like less, in my mind, it can become less appealing. I mean, the appeal of a platform like that is basically just being able to communicate with other investors, get really good data information, and it becomes an idea fest and the best ideas going forward. I mean, before Twitter, there were boards like Corner, Berkshire, and Fairfax, and these other sorts of individual forums that now have sort of all the stuff is transferred over to Twitter, and Twitter's been a much wider audience, and with a wider audience, you get much more refined viewpoints, because it's almost like going from like a local sports league to an international sports league all of a sudden, and I found it to be a really interesting platform because the level of analysis and thought on individual names and subjects that you wouldn't even think someone was even thinking about, you get a response. I mean,
well, you
it's
also
just
curate it well. So
well, yeah. I'm talking about just sort of. I guess I'm biased because I looked at financial Twitter. I'm sure there's other parts of Twitter that are total disasters, but I just don't traffic in those areas.
And also the other parts of finance Twitter.
I would say FinTwit's also a disaster, to be fair.
You just happen to have that curation.
Yeah.
People should be able to subscribe. I mean, for Twitter, everyone that you're subscribed to, they should be able to just follow kind of Keith's list, so then they can see all of the, you know, actually rational, well-educated people that you follow that maybe the rest of us don't.
I guess that's the way they could monetize it. I guess I don't know. I haven't.
Yeah.
Jeff, do you have any thoughts on like insider ownership, boards, etc.?
No. I mean, I think you can take companies over by embarrassing the board. I think they're mostly concerned, big public company boards, with being embarrassed, being sued, as I think a lot of public officials are in any of those things. And so I think a lot of these defenses and stuff won't hold up if you have someone who's really willing to do the kind of things that Elon Musk would do. But most people aren't, so just delaying is enough to turn off most people from trying to take over a company.
What about like the trend though? I mean, gone are the days of like Andrew Carnegie owning, you know, a third of the company, and if the CEO is not doing his job, you fire him, and it seems like there's a lot more inertia nowadays.
Well, some of the big media companies have voting shares and things. I mean, so Facebook and Google and stuff are basically your newspapers of today, and they have similar structures that protect them. You know,
you
Twitter doesn't.
On that?
I mean, Twitter doesn't. That's why that's happening there.
And I think there is a big signal in that kind of a setup. In fact, as I said, one of my conditions is good ownership interest. And unfortunately, you know, we have an environment where compensation has to be blessed by compensation consultant. One of the companies I own is Copart. It's out of Dallas. You know, it's the largest salvage yard company, and it's the only company that I have come across where they use a compensation consultant occasionally, reluctantly. And I think that is a big signal. That's a company where the founder is still the chairman, the son-in-law is the CEO. It's a dominant player in that space. Back in 2008, as the market was melting, the CEO, the founder at that point, and his son-in-law, the president, they went to the board and asked for a restructuring of the entire compensation program. They were just going to take $1 in cash and 1 million options. At that point, it wasn't necessarily clear how things were going to shake up. It looked somewhat similar to what's happening now. But to your point, Andrew, I think having an ownership interest, having a board that's committed, and particularly if they can have a compensation structure that's not blessed by a comp consultant. It's difficult to find these days, but there are a few. Copart is one of them.
I mean, that reminds me of it's interesting. One place you can look for is when COVID happened, especially for consumer industries, find out what management did. That's a perfect test to see where the money is. Some managers that did the right thing actually took cuts to actual salary and stuff like that, but that's a real-time test that I think we all can just take a look at the company and see, because management or whatever is going to tell you their story, but when the rubber meets the road, you take a look at compensation and how do they compensate themselves versus their employees and the other constituencies that are there. But that's I think that's a positive aspect of COVID is you can measure what management's sort of reaction to that situation was.
And that's not just the United States. I see that in a number of other non-US companies as well.
I'm curious if any of you have any thoughts on companies going public later in their life cycle. Geoff and I, we met with a public company CEO on Friday, and he went public as a microcap, and he took it public at like 10 times earnings purposely. And it doesn't seem like you're seeing much of that nowadays. So I'm curious if that affects how you think about it or what your thoughts are on that.
I think probably a lot of it really depends upon whether they have outside financing, right? Because a lot of the smaller businesses, they're really controlled by the VCs and these other guys that almost have another interest outside. If you have 100% control or a large control of the business, you can have that option. But I think a lot of the smaller, fast-growing businesses don't even really have that option, right? Because they're sort of at the mercy of the investors that they've gotten money from previously, and they see that they can make more money staying private than staying public too. And you've got some other things going on, the whole thing with the private versus public aspect of it too, that I think management and other sort of private actors can take advantage of public shareholders to get companies at really low prices, and there's really no checks and balances in that system. So I think that's part of the reason why you're seeing companies staying private or going private, and the offers you get. I personally experienced it a number of times where management will work with some external party and take the company under, and there's not much you can try and do stuff, you can try and make the case, but it just, if management is in control, or even if, the thing that's frustrating to me is that you get these large institutional investors that may be like index investors, and they're not going to be on the team of trying to maximize shareholder value because they see a cash offer and they're just going to cash it in right away. And the suggestion that they had at the annual meeting, which I think was very interesting, is saying, okay, if you're an index fund and you're just holding this for that, you should get no vote. That would be, I think, is a very interesting sort of solution to this problem, because if you're an index investor and you just want the return of the market, and you've got active investors that are in there, you have players taking advantage of that fact. But if there was a no vote, then it would be much easier to basically, I think it would make it much easier for bad actors not to take advantage of the system, I guess, is probably what.
Geoff?
No, I'm just agreeing with what Keith said that way. The biggest problem that I see isn't that they're not going public or whatever, but people taking companies public to take advantage of good valuations and then taking them private. It's happened in many things. We won't name names, but it happened with racetracks and things. It happened with restaurants. It happened with all these things that are very cyclical. You can take them at one multiple and out at another one. Car dealers, maybe. Keith was mentioning one that I think we said on the podcast is not a fair offer. But we said, are they going to get a better offer? No, I'm not really sure that they are. I wouldn't put the probability that high on an arbitrage, basis. But because and part of that was the country it was in and things like that. But also just a lot of people will take that offer. I mean, a lot of people, if you say I'll offer you 30% more than the current market value, even if it's ridiculously low, there's a lot of people who take that and move on to the next thing.
Yeah, because their time horizon is different than yours. I mean, what's being taken advantage of here is when people are buying their stock, and that's a huge advantage of Berkshire, is I think their shareholder base has a really long time horizon, so you see that wouldn't happen there. But in most companies, that's not the case, right? And all they need to do is get a certain percentage of their investors that have a short time horizon, and that's how they can get these deals done.
And I'm curious to hear, I mean, do you ever think about the shareholder base when you are underwriting a company? Is that something that you actively think about?
I do now. I'll put it that way. Originally, I didn't put a whole lot of, but it's a good point. Yeah.
Andrew's asking that question because we spend a huge amount of time. I mean, actually, people ask, like, what's one of the questions you always ask management? We always ask, who are your other shareholders? And there are some situations where we bought into one stock and not another because we're concerned about who the shareholders are in another one. And sometimes the shareholders can have an effect on management as a group if they can kind of shape their thinking about things. They would prefer usually a non-adversarial relationship. So they will do, if they have the right kind of shareholders, they will give into those kinds of things. And if they have the wrong kinds of shareholders, we were talking about a manager of a company, and he was basically saying, well, my stock isn't getting a lot of attention, right? Like, I'd like it to have more. And that's fine, but he owns almost none of the company because he's a new CEO in there, and the board owns almost nothing. And we kind of told him, like, you don't know what it's like to, you've run other things that were private or divisions of other companies, you haven't run a public company. If you draw attention to a company that is underpriced and performing well, you're probably going to get yourself out of a job. Yeah. That's actually the most likely scenario. It's not that you're going to attract Berkshire Hathaway type shareholders to it. It's that you're going to attract someone who comes in and says, you can flip it to a bigger company. And
Shree, do you have any thoughts on that?
No, as Keith mentioned, that's one of the areas that I have sort of evolved in. I now very closely monitor the current shareholders. That I can even go back and look at the past shareholders. But because I look for good ownership interest, some of my companies have more than 40% insider ownership. So the shareholder base doesn't turn over quite as much, but I still keep a very close eye.
I mean, another thing that I've sort of noticed too is that now you do have some shareholders, larger shareholders or groups of shareholders preemptively just trying to at least know who they are. So if something like that happens, you know, you're not at a disadvantage to the private equity or the management guy that's basically trying to take advantage of them. I've seen more of that happening, and I think that's good, but I still think, I really like the no vote thing that, I don't know if it was Warren or Charlie that said it or someone suggested it. I really like that solution, but we'll see how far it goes.
So all of the managers on this panel, I believe, pursue like a off the beaten path type of strategy. And I'm curious to hear what your thoughts are on edge, whether it's informational, time, behavior, and, you know, what you think your edge is. Do you believe there's some sort of informational edge anymore? And just your thoughts towards it.
So you asked me early on as to how I've evolved through this COVID period. And there was a time in the past when I used to think that information was an edge. I'm more convinced that it's more a behavioral edge that sort of is more lasting. And by that I mean more understanding your own investment philosophy and remaining patient. So I believe it's the behavioral edge that lasts. But it also depends on what type of a time frame you're investing over. I think traders and more shorter duration investors may have a slightly different answer. My answer is behavioral edge.
Yeah, I mean, I think you can have an edge in sort of more soft things. We talk to management not because they're going to tell us anything useful, but just to have an idea of what motivates them. And I think that kind of thing, to have a little bit more of information color to what you're seeing in the financial statements and stuff, is an advantage that you can have, and that's always what we're hoping for. We're never hoping for gaining more information that is of the same sort of data that you would get in financial stuff and those sorts of things. It's somewhat people or culture related, And that's the only time that we've gotten any information that I think is something that we as a portfolio manager or something might have an advantage over people who can't or are less likely to be able to get a meeting, to go to some places to do those sorts of things, to do it as a full-time job. But in terms of like getting data, I think that's something that Warren Buffett and Ben Graham and stuff could do, but I don't think it's something that we can do today. If it can be quantified in financial statements, then that's not an edge you can have today.
Geoff, I'm curious as to how you determine the culture part.
How I determine what?
The culture.
Oh, so I mean, sometimes we've come at, so a good example is I saw a company that was very, very cheap, extremely efficient, right? And so I wanted to see the headquarters. That was we talked to management stuff, and Andrew was all into that and stuff. And after the meeting, I was like, the management thing was fine. I just wanted to see the offices, right? And it looked real nice, the part the customers could see. But as soon as you went in the back, the most cramped, overworked, modest. You would not believe how big
customer-facing business.
Yeah, how big that company would blow you away. How big it was. It looked like something that was 1/10 the size if you saw the part the customers couldn't see. And so then I knew that they were frugal in the right sort of way, right? Because from the financial statements, all I could tell is they're really cheap. But some companies are really cheap in a way that is not sustainable for, maybe it worked for the last 5 years, but you're going to lose customers based on that. And that was a huge insight. And without that visit, I don't think I could have bought that company at that price.
No, that's a good point. I know there's a lot of companies where you can get more of just information. Okay, would this company fly? Would the management fly first class as opposed to coach type of stuff? And you get some idea of, okay, what's their thought process on cost versus being more extravagant. I mean, the other area I think where I've seen, and this is probably more behavioral than anything, especially in the consolidation space, is that a lot of the analysts won't include consolidation as part of their forecast when that's a big part of the growth plan of a lot of these businesses. And so that's another example. I don't know how you categorize that, but that's probably more behavioral than data, maybe a combination of both. But that's one area I think that I've seen that you can really take advantage of, because a lot of analysts, they won't put in future acquisitions even though it's a big part of a business's growth strategy over time.
You know, Buffett's talked about whether the ability to be a good investor is born or whether it's able to be learned. And kind of going back to the original question, I think there is a requirement that you have a certain skill at pattern recognition, and every great investor can create kind of corollaries and recognizes things. And that's where you get, over time, when you're reading the annual reports for 20, 30, 40, 50 years, that's how you continually improve, because you're seeing something that one company does or happens in one industry, and it reminds you of something else. You're seeing it happen, and you know, you can buy into a company before the end result happens, but you can see kind of the inputs, and you're recognizing patterns from that input. So, you know, I think you have to have an edge. Anyone who's good as an investor has to have that as an edge foundationally, and I'm not so sure that that's learnable.
So Geoff, you spoke about a company being frugal in determining the culture and stuff like that. I'm kind of curious to hear how you and other managers as well judge leadership and the CEOs at the top of the organization, and what that process is like when your boots can't be on the ground if you're analyzing an international stock.
I mean, you psychoanalyze them, basically. A lot of people think like good management or bad management. I try to figure out what really motivates them, and sometimes that aligns with us and sometimes it doesn't. We met with someone and I said, like, I mean, I think he's great and everything, but I also think that part of what he's excited about is not just winning, but being better than other people who didn't believe in him. Which might be fine. That might be a way that you can make a lot of money that way, but that's different than someone who just wants to become very wealthy, or someone who, there's all those little things. Some people want to be respected and important in their industry, and the share price doesn't matter as much to them that way. Some people just don't want conflict, you know, and you can see a lot of that when you meet with these CEOs. And from the outside, it's one of the biggest things that's different is when we get some insight into the culture from what people wrote up on Value Investors Club or any of these things, is that they just have the overall track record, but not much about like it's, or they're really competent or they're really incompetent. Usually that's not it. They're unique personalities that drove some of their decisions, and it's helpful to know that. And I think like reading The Snowball and having Buffett's insights when they talk about like the people who would sell to him and why he knew they would sell, and especially the early days, I think it was very powerful, his insights into people. And sometimes he was able to see more rationally what drove their behavior than they were. And that helped him in a few of his deals, I think.
That's an excellent point on incentives. Incentives aren't always monetary or financial. Sometimes incentives are, that respect or disrespect or something like that along the way too. And I think when you're looking at and you're judging the skill of management, which is a difficult thing to do, you have to gain some insight about what their true incentives actually are and make sure they're aligned with financial outcome for you as a shareholder.
And I know, for example, like in consolidation or consolidating industries, you can take a look at sort of their track record, right? I mean, if you've got a serial acquirer, you can see if their track record is good or not, and how is it really done. I mean, like, the Consolidation Software is an example of a company that does good capital allocation and knows, picks companies and basically knows how to really do, has a whole system built out. I think a lot of the good companies you'll see in both capital allocation and management of the business, they can clearly communicate what that strategy is, and you can see a consistent results in the historical execution of that strategy. And so, for example, if you look at a company, one of the companies that we hold is Asbury Automotive. They're basically So they have a clearly enunciated roll-up strategy, and basically they say the first priority is we're going to try and find we're going to roll up automobile companies in clustered areas, and that's going to be our first priority. If we can't find that, then we're basically going to buy back shares. And you go back and you take a look at the historical record, and that's exactly what they did. They'll take on debt to buy an acquisition. They did that for when they first came public up to probably, there was a period of times of 4 or 5 years where they couldn't find any acquisitions. Part of the issue with consolidation, especially in the auto dealership space, is you're buying from private buyers and the timing is uncertain. You don't know when it's going to happen. So what they did is they acquired companies, paid down debt. When they couldn't find anything, they actually went back and bought back like 30% of the stock. And now they're in another cycle of buying it back, but buying companies. But those are the kinds of things that sometimes you don't have the luxury of doing that, but if you can find those types of longer term records and people just consistently doing that, I think that's in my mind, that's one of the key things. But in a lot of cases, if you have new management, the record may not be there. And I don't know, it'd be interesting to see, how do you guys deal with situations where the record isn't there? Do those companies, do you just not look at them and cross them off your list? Or what do you do if the record is not there to sort of show whether companies are doing well or not?
For me, I view this type of an acquisitive growth to be somewhat of a challenge to handicap from my viewpoint. There are a few friends of mine from Sweden, and Sweden has a number of these serial acquirers. Many of them are very, very successful. I still don't understand how to handicap that kind of a growth. I used to do M&A as an investment banker, and I did M&A for a bank, and I know the challenges. Keith, you referred to the possibility of overpaying. That's just a financial challenge. Many times you run into cultural issues. A bank acquiring an insurance agency brings in a very different type of culture. One gets paid based on the number of loans made, and the other one gets paid based on number of policies and the growth. Completely different structure, and that brings in a completely different, cultural issue. But it's true that, Mark Leonard at Constellation and Lifco in Sweden and a number of different players have made it very successful. Since I find it difficult, I just stay away. And I would rather, some of my portfolio companies do make acquisitions. Fortunately, they seem to be add-ons, much smaller, and I'm able to at least live with those. But this type of serial acquirers, I stay away.
How important is the industry when you are researching a stock? I know, Keith, you've spoken a lot about consolidation tonight, but I'm curious to see if there are any characteristics or anything you look for, or maybe things that will keep you away from some companies. I always find it interesting when people talk about an industry and they'll be like, this industry has high barriers to entry, and then you learn about the main players, or there really are no main players. There's like 20 big ones. I'm like, are there high barriers to entry? So I'm just kind of curious how you guys typically think about the industries you're investing in.
For me, again, that's the first question. Is that something that I can understand? Is it within my circle of competence? And in fact, there was a great investment sage who is on this panel today who said 50% of the money you make just by looking at the right industry. Geoff?
Yeah.
You said 50% of the return comes from.
I don't know, agree with the first part of what you said, but yeah, the second part I agree with. Yeah.
So,
Well, yeah, and I think on the industry thing, what you want to look at is the number of variables involved. And so I'm industry agnostic, but there are some industries where I'll just not be interested, right? I'm a little bit more of a special situation investor, so I might be a little different than the way Shree looks at it. But certain industries have a number of different variables that are outside of the control of management. When they have input costs, when they have commodity issues, when they have international supply chains, et cetera, that any one of them could be disrupted in some way, in an unpredictable way, possibly. And those are more difficult industries to get predictability on, because basically you're trying to get some sort of predictability. That's how you can make assessments 3 to 5 or 10 years out, and then backtrack them to today's price. So I think generally you want to look for fewer variables and variables in control of management, and one variable is the talent of management.
I mean, one thing that another way to sort of characterize businesses is by business models. And that's the way I have a tendency to think about things. I'm trying to find business models that have decent operational leverage, so I know if I can get the growth, the margins are going to be increasing too. And so there's industries that have those types of characteristics that may have a large amount of fixed costs, that the incremental margins get higher as the revenues go up. And so I think a commonality amongst the types of businesses I like to look at are ones that have those characteristics. And it's interesting if you can just sort of, at least that's one of the sort of things I look for the industries and that have that type of sort of characteristic. And it can add, it really sort of blends into sort of this almost Davis double concept, where if you can find a company that has those kind of characteristics, that historically, the multiple's low, if they can generate high revenue growth along with operational, earnings growth, then you can get both, a very large increase in earnings along with a re-rating of a multiple. And so those are the kind of situations at least I try to optimally find. Not going to find the perfect thing, but that's what I'm at least trying to search for.
Geoff, any thoughts on
Yeah,
industries?
Industries we're terrified by fast asset growth, and really attract industries where we think supply is going to grow slower than it should for any irrational reasons or any pessimistic reasons or whatever. And we're scared of the ones that are able to attract a lot of capital, VC-backed things or whatever, that might even, while burning cash, be able to compete with you. That worries us. So fast growth in assets and anything like that is really what we avoid, I would say. And it's more avoiding those kinds of industries. Yeah.
And when Shree had used your quote that you think 50% of a stock's return comes from the industry, why is that? Can you explain that concept?
Look at the past 100 years of stock returns and see how, if you were in coal, what was it? If you were in tobacco, what was it? And if you were in shipbuilding, what was it? If you were in, advertising, what was it? Or media, or there's so many different things. And it isn't that hard to have predicted that ahead of time. It's silly to think that 100 years ago you'd think, that there isn't a difference between those things, that they're equal. People could tell that some of those things were how people made fortunes, a lot of people did, and preserved them for a long time, and other ones were incredibly cyclical, and fortunes were made and lost in those industries. And that's fine. You can make a lot of money in a cyclical industry if you get in and out, but look at all the things people made for generations money in. There are a small number of industries compared to all that's out there for you to buy stocks in.
Sorry.
No. Yeah, one thing I did before that I think in being a business appraiser is we looked at a lot of private companies. And that's one thing. And a lot of these companies, guys can make a fortune in a generation or two. And the characteristic of a lot of those businesses is they're not that capital intensive. And like you're saying, those types of businesses may be under the radar of public companies, but distributorships are a perfect example of that, where everyone else is financing you. You don't have to put much capital in, but it can create a lot of wealth early on. And if you could find public companies that are doing the same thing as these private guys have generated wealth in a generation, and it's wealth that sticks around. It's not like you're saying the cyclical stuff. I mean, oil is probably the perfect example of where guys have made and lost fortunes maybe 3 or 4 times in their lifetimes, right? And when you don't get out, you're playing the roller coaster ride. I don't know, but that's...
Yeah, what I was going to say was, Jim O'Shaughnessy has written a fantastic book. It's called What Works on Wall Street. It's a doorstopper of a book with 600 some pages. Page 536, there is a small table in there. He lists the returns and standard deviation by sector. Guess the top performer. It's consumer staples. If you wanted to guess the worst performer, want to take a shot?
Energy?
Or airline, yeah.
It's energy.
Airline, yeah.
So consumer staples was number 1, and energy is the last one.
You guys set this up before?
Yeah, we did. No, we didn't. So I don't think any of you use a Bloomberg. So I'm kind of curious because maybe there's other people here that do not use a Bloomberg. What's your research process like? How do you get your information?
I don't use a Bloomberg, but I use Capital IQ, which is S&Ps. Gives me global access, and I'm able to download even non-US company financials, transcripts. I don't use any outside sell-side research. Research is all on me, and I've developed a large global network. I'm able to talk to friends in Sweden or Poland or wherever outside the US, and within the US I have a fairly robust network. And COVID hasn't allowed me to travel much, but hopefully in June I'll be in Europe to meet with many of my management teams. So it's, database is one of the sources, but a lot of kicking the tires on my own.
I send out a tweet asking for your best ideas, and you all give them to me.
I do that too. I do that too, like once a quarter. It's a great way to source ideas.
No, but that actually is not a bad idea generation thing. And I want to go back to the idea of the network. The network we have up here and other fund managers, investors, and intelligent people that we interact with. You get a lot of, not only get some ideas from them, but also it helps in the research process when you're talking with someone who might have specific experience, operational experience in that industry, and or may have gone through something like that. So the network's been very valuable, but I think I think you want to be very careful about where you get your information from, going back to that idea of information overload. And for me, the primary sources are always more valuable and obviously more accurate, but it's important for you to put in the time in those primary sources and don't take shortcuts, which I think sometimes with Bloomberg and other things like that can be too much of a shortcut.
I mean, one thing that I found that's sort of interesting working in the international markets is finding situations that are, let's say, favorable in the U.S. that may be analogous to situations overseas. But you got to be careful because sometimes the markets can be completely different. Like, for example, if you look at broadcast TV, the U.S. players in that market have huge advantages that the international players don't. And so, but I think that's one area I think that I find interesting because sometimes you'll find that large price discrepancies between sort of, a particular company with a particular business model. The business model is the same here and overseas, but I think that's an opportunity that I've sort of seen and basically we've been able to take advantage of in the fund over time.
Yeah, I do some screening and stuff like that, but a lot of ideas brought by people who listen to the podcast and things like that. Occasionally, it's like ideas are related companies of things that we already own, because you're kind of comparing like. Usually, we don't want to be all in one kind of thing. So even if we liked banks a lot or liked energy a lot or whatever, we're only going to have a couple in there because I'm not going to diversify and own 20 of them, right? So we kind of compare to what's our favorite thing that we already own. And then sometimes that thing years from now will be what we end up buying. So it's usually how we get to know it is that it's a very interesting company, but we already have something like that right now. and then we follow it. And most of the time, I'm buying something that I learned about years ago. It's rare that we just found out about it and then we buy it.
Something that's been talked about a lot recently is Munger's position in Alibaba and people cloning him with his 13F. I'm kind of curious to hear what your thoughts are on 13Fs, if you follow any investors religiously and using 13Fs as like a idea generator.
It's another evolution on my part. I used to, and now I don't.
Why is that?
Many times the decisions they make and the conditions under which they make those decisions is something is absolutely not evident to me. And so over time, they make certain decisions that many times have been in contradiction to how I would think. So run into a couple of situations where followed certain high-profile managers, owned the stock, and I later found out that they had sold it. And so, I realized that I have to be myself, do the work on my end, and I make the decisions based on the environment and the analysis that I've made. I don't have an opportunity to point fingers at somebody else. So,
I mean, one thing I found useful is if I know my investment framework is similar to, let's say, another investor's framework, and as Shree said, I used to do a lot of 13F stuff, but I don't do a whole lot now. Sometimes it's helped me if I know what their thought process is, then being able to say, okay, here's the set they've looked at, here's what they've bought, and is that similar to mine? But I think each of us as managers have sort of developed sort of a unique sort of, call it like a filter of things, and that's part of the process is developing this filter. And then if you found someone that's filtered and come up with something similar, you see whether it fits in your framework or not. And because it's tough unless I don't think you can really do cloning effectively unless you really understand the thesis and from your own filter, you've got confidence that this meets the sort of criteria that you feel comfortable with.
and also, the last firm I worked for before I launched SVN Capital was Kiel Asset Management. It was acquired by Mario Gabelli, so worked for him for a little bit. And a particular name may sort of pop up as a new Mario Gabelli purchase. But it's actually one of his analysts, and even though his name may be associated with it, he may not have any idea about that particular investment. And so it's in my mind, it's not a true, it's not a whole lot of help going after these types of 13Fs. In certain situations, it may help, like Monish Pabrai, I know he does his work, or Guy Spear for that matter. There are a few that do it that way. But for the most part, some of these big names, the actual PM and the analyst will be completely different, and it may not necessarily match.
But I think even when Monish does it, he has a relationship with Charlie Munger. So, I mean, none of us, I mean, I can speak for myself. I don't have like a relationship with these guys that I can say, okay, if I clone it, I can go ask them questions about it, right? I mean, so I think it's a much more difficult exercise than it initially appears to be, I guess.
Yes.
Outside of the 13F, though, if you could follow some activist investors, especially on more small caps, that can be interesting. There is a benefit to riding the coattails and sometimes even getting involved peripherally with them. And I think particularly as a special situation investor, particularly with some of the small caps, there's some bank activist investors and there's some others in the field that, not so much a 13F, but if you read their analysis and dig in yourself, there's some comfort you can take and sometimes there's some great opportunities from that.
I'm not really a fan of following the 13Fs. Sometimes they tip you off that an industry is interesting because some investors, Warren Buffett, Glenn Greenberg, people like that, they are not going to invest in something unless they see something structurally with the industry that they like. So I don't know if you should follow Buffett in Occidental, but he's telling you something about that industry. If he's, whether it was taking the warrants or buying it or something, he has an opinion about that. He might be right, he might be wrong, but Buffett doesn't do something that is without having a view on the structure of the industry and what its future might be, right? Like he did with airlines. That kind of thing.
Like you're saying, it was very interesting. There wasn't a whole lot of talk because he bought Chevron and Oxy. That's like $35 billion. When you look at the total portfolio, that's a huge position, but there didn't seem to be a whole lot of discussion about that. I was surprised there wasn't any questions that specifically asked that, such a large position, what was the thesis or rationale behind it? He got more into, we was talking more about the mechanics of being able to buy the stock. He never got into the rationale for why he bought it and why he thought maybe oil was a good thing to invest in. Now,
Did anyone ask Munger about Alibaba, or did I miss that?
Yeah, someone did, but Munger didn't respond.
Yeah.
Someone asked about his investment in China and if he's still confident in China, and it seemed like he was kind of
Yeah, I remember that too. So I don't know if that gets picked up or not. But he said there was a general question about China, and he had some comments on it, but not any specific response with Alibaba, which is pretty interesting, right? We had an entire day of questions. I guess there weren't very many questions this year. But Charlie levered it up, bought Alibaba, and probably a few of you followed him in, right? And so, that's a danger. It's a danger to it, and probably more of a danger than an opportunity in my view.
So I'm going to ask one more question, then we're going to open it up for questions from you guys. So how are we doing this, Jess? Raise your hand if you want, and then we'll pass around a mic for you. But I wanted to offer you guys the opportunity to give a 1-minute teaser on a company you've been looking at recently. If you don't want to give the actual stock idea, but a theme, something you're currently focusing your attention on that you think is interesting.
But not.
It could be in the port, whatever you want. I don't want to put you on the spot.
Yeah, I'm actually very interested in what's available in Sweden. It's a very high quality set of companies, and there is a publicly traded company in Sweden called MIPS, M-I-P-S. That's also the ticker. It's a capital light business. They make helmets or helmet safety technology. They don't manufacture. They make the product available for cyclists, for miners, for a variety of different race car drivers, for a variety of different uses. The founder owns a big chunk of the stock. There is no debt on the balance sheet, phenomenal returns, but insane valuation. So that's one that I've continued to keep an eye on, and it's not in the portfolio.
Yeah, I'm not going to give a tease of something that we're looking at. We talked to someone recently, a couple people recently, about Japan. Would love to find something there with where the yen is and where the dollar is and everything. But I'd love to own more things in some other countries, especially with some things with the currencies. But we've had a really hard time duplicating the kind of information we're able to gather about companies and stuff here with those countries, and maybe over time we'll be able to build up some sort of networks and things in those places, and that could be a little bit more opportunity for diversification to repeating what we do here in some other places.
Yeah, I think in terms of a specific idea, we talked a little bit about sort of Asbury, and I think the traditional auto dealers is an interesting sort of area to look. And the ones that I've observed are probably the two closest, the ones that have really sort of adopted the integrated approach of having multiple places to monetize, let's say an auto customer, have been primarily Lithia and Asbury at this point, and they also have the combination of Asbury really focusing on the clustering where all the economies of scale, where most of the economies of scale from auto retailing happen. So I think
Company, right?
no, they're both U.S. companies. Asbury and Lithia are both U.S. companies. But I think that's right now. I see that as being a space where there's a huge difference between the top player and the bottom player. There's low multiples, and you probably can get a tremendous. I believe you can get there's going to be a tremendous amount of growth just through consolidation. But there's a lot of noise in the fact because everybody knows they're over earning at this point, but by how much can be sort of it can be controversial. You really can't put a number on it, and so you get a lot of stuff that sort of gets thrown together, and some people I think just ignore it because they say, okay, well, it's over earning, it's a cyclical over earning, so it's not in my set, and they don't. It sort of because the numbers just become really compelling. Like for example, if you look at Asbury just had a release. They did a big acquisition, and they're estimating that they're going to be able to make between $55 and $70 a share in 2025. I mean, the price went up from what is it, 165 to 175 on the news. I mean, you just look at the math on that. If they even get anywhere close to that kind of growth, you're going to I think you'll have both a higher base and a re-rating of the multiple that can happen there. And it's not only them. Lithia is the same thing. So, you know, either these companies are totally out to lunch, or the market just is not really sort of incorporating that aspect of what's going on in their business. So those I think are interesting ones that people want to just sort of find the highest, at this point, what I think is some interesting risk-reward type situations that aren't too levered.
Yeah, I mentioned St. Joe's earlier. I'll just say two others, Namtai Property and Goedeker over warrants. I've written about them both, and if you're interested in that writing, you can talk to Jessica in the back. She might be able to share that.
Excellent. Does anyone want to ask a question for any of these managers? Got a couple. One behind you.
Thanks very much for the time. Appreciate the great discussion. Just curious if we could talk a little bit more about your discussions with management and how you think about how to balance the risk of confirmation bias and having those discussions where I imagine it's the case that when you get to that point in your process, you probably decided that you're interested in the business. Just curious if we could talk about that a little bit.
So I have mixed feelings about this one. I generally tell people not to meet with management, but I meet with management, so I'm a hypocrite on that. Maybe I'm not as susceptible to that, or I'm more suspicious of management or what it is. But yeah, I mean, we generally would meet with management at the latest stages, although honestly that's really from like the Phil Fisher perspective of the more you know from people around management, the more you can drop hints early on when talking to them that you know some things, and then they'll open up and talk more honestly about that. In fact, frankly, we kind of guess and say like, here's how many customers I think you have. You know, and they won't tell you, but okay, that's not a bad guess. Here's how I think you're making in this business and that and whatever. And yeah, I think that's helpful. I also think that it's helpful for us if we're going to buy a major position, a meaningful amount of their votes, that I'd like management to feel somewhat secure with us doing that, and also maybe more receptive to hearing from us. We're not activists, in the sense of I really don't think be publicly very hostile or anything to a management, but certainly we would like to have an influence through a much more cooperative sort of approach and a very indirect approach where hopefully we don't have to actually say what it is that we're interested in, but they have a clear idea of what we would like to see, and they know that we own some stock, and that's based on meeting us.
For me, I look for management meetings. Even outside the U.S. As I said, I haven't been able to travel because of COVID, but hopefully I'll be able to travel beginning in June. Going in knowing that there is a possibility of being influenced by management's charismatic approach and answers, I think it helps to have that in the back of mind. But you can certainly pick up signals from body language. I've seen that happen and I missed it. I paid a heavy price. And so I look for face-to-face management meetings.
I mean, I think when I meet with management that we, again, you have to be, I'm constantly aware of these guys. The reason that they're CEOs is they have a tendency to be really good salespeople. And you have to be careful when you're going in that I have some very specific focus questions in areas that I may have concerns and sort of see what their response is. But part of it is just if the management has been there long enough, you can sort of see what results they've produced. And most of the companies I'm looking at, these management teams have produced really good results. So to a certain extent, the results speak for themselves, and if they've got a coherent strategy, it makes sense to me in terms of from a strategy perspective of how they've gotten there. I think that provides more comfort, but I think for me, a lot of it's just, as a manager, just being aware that these guys are CEOs and they're probably good, they are good salespeople. That's how they got to the position that they're at, and being able to, you know, be just realizing that when you're going in, I think.
I think that covers it.
Okay. Okay, all right.
Next question. Who wants to ask? There you go.
Hi. So my question kind of relates to like the impacts of like passive and like index investing on your guys' strategies. I know you kind of touched on the impact of like voting rights, but I kind of just wanted to ask more with regards to like the inflows and outflows type of thing. So you know, they kind of touched on Warren and Charlie kind of touched on this in the annual meeting today with regards to like, you know, passive investing has gotten increasingly popular. Indexes are extremely popular, and I think someone during the meeting said that they consist for over like 50% of the U.S. markets. So I just kind of wanted your guys' thoughts on if you think that the increased popularity of index investing, do you think that that poses a danger to anyone that passively invests? And then do you think that inflows into passive investing due to like, you know, if you're passively investing, you're not really concerned with the value of the underlying security necessarily. So do you think that creates more opportunity in like small caps or possibly investment scenarios outside the United States?
I mean, I think the challenge there is that it may produce more opportunities, but the exit, when you think about when you sell the things, it may prevent an exit too, right? I mean, it's really on both sides of it. So, you know, if something's not included in an index, for example, I guess what would be the best situation is if you have a small company that's not in an index and then it gets into an index, right? Because then you'll get that bump, or there's some other external event that would drive it, like a takeover or something like that. So I mean, that's from that perspective. But I mean, I think generally the voting thing, in my mind, is probably one of the bigger things, and people are just sort of thinking and processing that. But that's just, I don't know, it'd be interesting to hear what other folks' thoughts are on that.
Yeah, I mean, with the passive thing, I think the biggest risk is probably in terms of sectors. So you'll be way overexposed to certain sectors at times. I also think that's reinforced by quant things that we see, because many quant things try to match the same sort of sector weights that you see in an index. Instead of, say, if they're just based on value, they buy the cheapest stocks that are out there regardless of what sector they're in. And honestly, I see more impact on the stocks that we own and look at and stuff from quant type stuffs than true passive. I really have a trouble evaluating how much that's changed the market. There are some other countries that have tremendously high passive investment. We mentioned Japan. Japan doesn't have a really good active stock selection sort of thing and hasn't for a long time.
I think there's potential issues, a number of different issues. Maurice Stahl at Horizon Kinetic FRMO is a good one to follow on this issue. But specific to ESG investing, for example, and the type of pressure that BlackRock is putting on companies to, I want to say politicize, but at least provide additional disclosures, perhaps change some of their business practices, and to involve other stakeholders, sometimes more so than shareholders themselves, which I think is a little bit dangerous. And the power that can be kind of exercised by a BlackRock in a number of different companies is, you know, it is a little bit scary. I think Buffett has a concern about it. You know, what can we do about that? I don't know. You know, I mean, we're kind of riding a tide, but I do think it creates some opportunities for us as stock pickers, especially the ESG related things. And you know, there was a time where the sin companies, you know, Altria and alcohol and firearms and all that stuff, you know, still maybe has a negative connotation. But you know, look, if you want to make some money off of that, there's an opportunity there. I don't own, well, I do own Altria, not in the fund, but you know, this is a cash flow generating business that throws off it's a nice dividend. It's fairly predictable, and you know, if you have an alternative view, there's an opportunity there.
I have nothing to add.
There you go.
All right, so this is kind of a two-parter type of question. First off, I wanted to ask, how do each of you think that the Fed is going to handle this inflation and CPI problem that we're seeing so far? And do you think that they're going to give us a smooth landing or a crash landing? And depending on what your answers are to that, I'm also wondering how you're advising your clients to more or less, the term would be, I guess, immunize their portfolios, and are you looking at inflation or I bonds to do that?
You know, I would say, I mean, I think we all run our own funds, so we're not advising anyone, which is an important point. So we're the decision makers, the direct decision makers there. And, you know, I think it's what the Fed is doing. You know, they're going to have an aggressiveness. They've been a little bit aggressive, and we'll see if the actions follow through to the same level of some of the talk the next two sessions, so to speak. But clearly they see it as not a transient issue, and I think we can see that in all of our research in the companies we're following. We'll see how quickly their actions have an effect.
Yeah, I mean, I think the one thing that we've looked at is basically just trying to, you know, avoid sectors that would be hit just by a situation where there's, you know, higher inflation and higher interest rates, and maybe and exploring potential investments in areas that do well in inflation, you know, and that primarily being maybe some energy stuff that previously may not have been as interesting, and some sectors in real estate. At least that's it's sort of, for me, it's sort of more opened up a broader set. Some of the themes like consolidation, I think, is going to happen no matter what. So that's almost, I would say, it's not independent, but it's not related as much to interest rates, because the economics of those types of consolidation processes, I mean, interest rates would have to get astronomical before those didn't make any sense anymore, because what will happen is that the process will still happen, and maybe they'll just be bought at lower multiples, and you're still going to get the synergies coming out the other end.
There'll be more volatility because of Fed actions?
For sure. I mean, in some...
It's a good thing for us.
Yeah.
I mean, I think you have to be prepared for all the things that could happen, and not just the one scenario that you think is most likely. So if it wouldn't make sense to buy a stock because next year there could be a recession, then you shouldn't buy that stock. There's going to be recessions in the future. There's going to be higher interest rates, lower interest rates, whatever. Just because you put a probability of 70% on some outcome, that you have to worry about that other 30% too. And, you know, I would just think that you need it under a variety of different scenarios to work out, and I wouldn't bet on one single scenario, even if that is one that you have confidence that you are better able to predict that than most people. You keep in mind the, you know, other possibilities.
For me, I'm reminded of another Buffett's quote. You know, when you think about some of these questions, is it important? Yes. Is it predictable? For me, at least, it's not. So I don't think about what the Fed will do next and what the impact would be. I just focus on the company. And I talked about Dino Polska, for example, and one of the differentiating factors is they own the real estate, and they own the real estate under the stores. So it's a sort of a natural inflation hedge. When in Poland, inflation is about 10% at this point, when many of its competitors are leasing land in big cities and incurring the additional cost, Dino Polska is able to use its real estate as a natural inflation hedge. So I would rather spend time looking at the company, looking at the structure, and as Keith mentioned, historical review of the company will tell me whether I can actually get any confidence thinking about the future. So your first part, I'm not able to answer. The second part is sort of an escape answer, I guess.
I liked the question that Shree asked Geoff on culture. And your answer was interesting with this company that you visited, the headquarters, and you saw they had a really nice part for the customers, but then the employees were cramped up and it was modest, and you said frugal in the right way, and I like that, and as a shareholder that's what you want. But also, so my question is, how do you dig deeper into that? Do you check so you make sure that the employees are actually satisfied with their jobs and they're not just cramped up and forgotten and not living a really good life there? And also for all of you, the question is basically how do you treat your customers, how do you treat your employees, and ultimately, of course, the shareholders.
Yeah, so in that case, we knew a little bit about why the employees worked there. Basically, they had worked at other banks and things like that. It was a bank that we're talking about. And they were paid based on transaction type stuff. And so then you would have to top that, the next year, no matter what. And what they were most interested in just serving customers so that once they had a relationship, they could just maintain it. And this allowed them to do that. And so I think that they were happy doing that. Now, I think they may have been earning less money than they could have in some other situations. And it attracts a different kind of person to that. I don't think that it would necessarily attract the highest quality people, although it might attract people who are competent enough and able to be there for the long term. And I think that's not the worst thing. I think a business that has to attract the best graduates from that area or something can be kind of a tough business to be in. So we had some idea that way, and that's what we look for. You can obviously try to look for things about how happy employees are. I'm a little skeptical of those kinds of things. I want to know, like, specifically in what way they're happy, what's motivating them, not like a score that they're one of the most respected companies or they're voted one of the best places to work for or something like that.
And understanding culture is, at least from my standpoint, it's not just a one-time event. It's an ongoing exercise, and things change. You in fact, want to learn a little bit more about the culture, particularly during tough times. And so for me, it's an ongoing exercise, and I use a couple of different outside service providers to help me with that. So there is a source called In Practice, which is an expert network based in the UK. There is one here in US called Tigas. And you can read a lot about what competitors are saying about this specific company or how the employees, it's usually former employees from the company, why they left, and all those sort of interactions will give you an ongoing color about the culture. And in fact, back to Buffett, 2003, he met with the CEO of Freddie Mac. At that point, they had invested in Freddie Mac for a long time, and 2003, I think they met with the CEO of Freddie Mac, and soon after, even though the company was doing great, they exited the entire position. Later on, many years later, Charlie Munger mentioned this, that they sold it because the CEO had indicated that they had great plans about future growth. And the kind of growth that he was contemplating was not in line with what Buffett and Munger had in mind, particularly for a financial services company. And that was a signal that they picked up. I had a very similar situation, and I did not, and I paid the price.
I think part of culture is almost like a mosaic, right? It's not like one thing, like Geoff said, there's not like one survey that it's going to tell you, but you have to just pull together information from disparate sources like some of the other panelists have said here, from interviews of other people. Does it make sense? How does it's more of a qualitative thing that really is, it can be hard to quantify, and that may be good, and that's part of the reason why, if you could find a good culture, and I like the idea that Shree was talking about, how have these guys handled stress? And I think COVID is a perfect opportunity for a lot of businesses to see what happened. And a lot of stuff is now reported and stuff, so you get like almost an objective as opposed to management spin of what happened. You can see companies where COVID happened, all management teams, they cut their salaries by a certain amount. They tried to support the employees so you can sort of see those kind of things, and I think COVID provides a real-time case that there's a lot of data out there that you can collect on that. So I think that's a current thing that you can take a look at. It's not the only thing, but it's clearly part of a mosaic that you're trying to put together to sort of recreate what you think the culture is, right? And part of the issue, again, like with the CEO, is they're going to be good salespeople, and you have to sort of separate between, is he doing a good sales job, or is that the actual way it is, right? So.
Yes, I want to ask you all, about this book, Capitalism Without Capital, right? It describes the process, how intangible capital has been growing as a percentage of total capital invested in multiple developed countries. And connecting it with value investing, value investors have shied away from investing in technology companies. To me, it seems like mostly because Buffett himself had shied away for various reasons until he invested in Apple. So my question to you is, intangible capital is not all technology, but the book makes a point that it is, majority is technology. So if that movement has been happening at country level, and it obviously presents opportunity to investors, and value investors have been shying away from that sector or from that area, has that been a mistake, or has it, has that been an oversight by value investing community? And if you do agree with that, then what's the barrier? Why is value investing community not looking at that aspect more carefully without getting caught up into the bubble?
I think that's going to be reflected in sort of the return on tangible equity or equity you'll see in the businesses. So the ones that have a lot of intellectual capital are going to be selling it at large, at usually premiums to book, and will have really good returns on invested capital. And I think when that sort of thing happens, I think the way you have to value the business is more on what you think the future cash flow of the business is, as opposed to the assets. Now, historically, value investing has been focused on the assets, but if you have an asset that's generating huge returns in excess of the cost of capital, I think you just need to, in my opinion, you need to put more weight on the earnings, what you think the earnings or cash flow of the business is versus the assets of the business. And what's happening over time is businesses are using less and less tangible capital, and as you're saying, more intellectual capital, which will lead to, I guess, a conclusion that more and more businesses would be valued on their future cash flows as opposed to their current assets, because the businesses are generating a lot of cash flow from those assets, and as they get more and more profitable, the asset value becomes less and less material versus the income they can generate from the assets. I don't know, at least that's my thoughts on it. I don't know what you all's.
Yeah, I'm not sure there's much of a difference between having losses for 10 years or something and putting up a lot of capital up front. I think they're pretty much the same sort of thing. And I think that a lot of what we've seen with the internet isn't all that different than when we saw railroad booms and things like that. And we'll see with some of these. There will be some huge winners, but there are also ones that, when you do a net present value going back now, looking at what happened, it's not that different than if you'd put a lot of capital up front and then earned a poor return. You got to look at the stock chart. And so far, Twitter, it might be capital light, but it's the same thing as if you put in tens of billions of dollars and earn poor returns on capital. It's very similar.
I guess I get to ask two questions because I'm sitting in the first row. First of all, thank you all for sharing time.
It doesn't mean we have to answer them both.
Views and thoughts.
But we will.
First question is more on secular compounders, any of you that focus on it. Of course, if somebody invested them, either they invested at a low valuation or for the sake of growth in stock price along the intrinsic value per share growth over the long term, right? So occasionally, either due to market exuberance or over expectations of the company, the stock price could reflect a poor on forward going risk reward for the company, even though it's still a great company in the long term, this is a track. So how do you guys think about it, and especially if you need to replace it, the same market conditions that created it could be causing it for other stocks also. So going to cash like a retail investor is not necessarily an option. So how do you go about it? That's the first question. Second one, you can take it towards the end. The first one thing is, what is some important lesson that you guys learned, you wish you learned earlier? I'm not employing any of you are older, but maybe a few years earlier, what is one important lesson you wish you learned?
Yeah, I'll take, the first question, I used to employ this method more heavily, and still do a little bit, something called balance sheet to income statement investing, where I would look for companies that are trading book value or below, that are undergoing a transition. And the opportunity there is that investors, traditional Ben Graham style value investors, that were focused on the balance sheet would be interested in those companies trading at kind of cheap balance sheet valuations. But if the company was going through a transition, possibly because there's activists involved or there's some sort of change in business direction or a divestiture or something along those lines, and you see a pathway to it creating sustainable free cash flow generation over time, where then future investors, growth investors, so to speak, would judge it on some multiple of earnings, free cash flow, etc. And you could get exponential gains from playing that transition. And so that doesn't directly answer your question, but that's something that I've kind of done in the past successfully. And it happens, oftentimes with smaller companies that are going through some sort of special situation there. The second question, I think it goes to some discussions I've had with people in the audience and some other people interested in starting a fund and getting involved, maybe transitioning, their career. And this is something I did. I transitioned from being an attorney to starting the fund 10 years ago now, and then eventually getting involved with Willow Oak, Enterprise Diversified, and handling all of those operations. A little bit of a plug for Willow Oak because it was a huge burden, to handle all those operations of the fund in the beginning, and to find great external partners and not try to do everything yourself is very valuable, not only for the growth of your fund, but for your returns, I think, over that time period as well. So look for great partners, and if you want to get involved in investing, on the investing side as a fund, there's so much work and potential distraction on the operations side. So whether you're finding a company like Willow Oak or whether you're partnering up with someone specifically on the operations side, I would recommend doing that. And I think there's the old saying that if you go alone, you can go fast, but if you come together as a team, you can go much farther. And I've learned that over time because I really probably had a lot of brain damage on the operations side the first few years of my fund.
I'll answer your second question. I'll leave the first to Geoff and Keith. I wish I had realized the importance, the power of what Charlie Munger has said many times, which is if you focus on the quality of the business, if a business generates 20+% return, if you focus on the quality of the business, the price you pay may not necessarily matter if you hold it for a long enough period of time. On the other hand, if you pick up a business that's generating mid-single digits or whatever, but you're able to pick it up at a cheap valuation, if you hold it long enough, your returns will reflect the returns of the business. I think that's a very powerful observation. I wish I had stumbled onto it and realized the potency of that statement very early on.
Yeah, I mean, in terms of what I wish I'd learned earlier, I'd say it's not necessary to kind of over-optimize for one variable. You don't need to buy the cheapest stock that's out there. You don't need to buy the fastest grower or the one with the widest moat or the best management or any of those things. If each of those variables is kind of good enough, then often you're going to get a better result and a more predictable result from doing that than trying to weigh how much the trade-offs are between them. It's very, very hard for me to calculate, okay, the management is terrible here, but it's trading at a third of what the replacement cost is or something, right? Those often will work out really well, and sometimes you'll make those investments and it'll teach you to keep making those. But there is a big trade-off, and it's very hard to do that math. And it's much easier to do the math that this is somewhat better than the median on all these different points and not know how you'll get your return, but you will get it. And I wish I'd learned that earlier.
Yeah, I mean, as Geoff was saying, I think part of it is a lot of these parameters you're trying to estimate when you're making these things are uncertain, and a lot of it depends upon industry. Some of the uncertainties are really big, sometimes the uncertainties are really small, so trying to quantitatively say this company is better than the other, I think is difficult because the error bands are so wide in some cases, and there may be other factors that are even outside of just valuation and relative growth that could drive the business, especially if it's going through a transformative time or a disruptive time. There's lots of things that can go like that. I think for me, what I think I would have wished I would have done earlier. I'm pretty much a value at heart type of investor, but what I've been doing, I would say probably over the past 3 or 4 years, is basically just exposing myself and listening to really good growth theses and really trying to understand that approach of thinking. Because I think, as Buffett says, value and growth are attached at the hip, but I think when people first pick up the intrinsic value concept, a lot of times they think of the value aspect, but there is a good amount in growth, and there's tons that I have learned from growth investors. And I think that is something that I wish, if I was going to start over again, if I would have grasped onto that and appreciated what growth investors can teach value investors early on, it would have saved a lot of time. And some of the observations, like Shree had said, it's a result of that. I mean, that's why these guys are investing in growth investments, because in the end, if you look at long periods of time, your investment return is going to approach the return on equity or return on capital of the business. And so I don't know, I guess the biggest thing for me is basically just getting exposure to a different way of thinking about things and then reflecting on that, I think is...
Yeah, and the key there is your growth investors that you're looking at and learning from are still fundamental investors.
Yeah.
Bottom up. And there's a lot of participants in the market today that think they're growth investors that don't do fundamental analysis. And so, there's a distinction there. And, we're seeing the result of that, I think, this year and probably over the next few years, those who do research and those who don't.
Hi, good evening. Thanks a lot for sharing your insights. I have one specific question, as in, oftentimes a lot of fund managers and investment managers talk about the importance of having a good quality management in the business. How Buffett himself says, I want to buy wonderful businesses at fair prices, but with a good quality management in place. Now, as a young investor with not that much a sufficient amount of capital, what are some tangible methods that I can employ so that I can assess for myself as to whether these management practices are good quality or not? Except for the plethora of knowledge that you can get through YouTube, interviews and stuff like that. How do you get access to management, and how do you kind of see for yourself whether these practices are employed towards wealth creation in the business, or whether the management incentives are not aligned to my interests?
Yeah, I think you want to look at insider ownership. That's a big thing, and see where their incentives are there. And COVID's changed this a little bit, but going to the annual meetings, especially for smaller companies, you might be one of only a few people there, and it's also a good way to network with other investors and shareholders. And that, I think we got a lot of advantage. I did in the beginning of my fund, just by simply going to some of those shareholder meetings. The alternative to that is finding companies that are such good businesses that any idiot can run it also.
Yeah,
there's some out there.
I mean, one thing you can look at is take a look at their capital allocation over time, and if the management's been in place for any period of time, 5 years, 10 years, you can sort of see what's going on, and you can sort of say, okay, how have these guys, have they grown the business? Has the business been flat? And are they doing things that could improve that over time? So, for example, the Asbury example that we talked about earlier, in businesses, there are certain capital allocation decisions that can happen over time. You can do acquisitions, you can do stock buybacks. When they say they're going to do it, do they say they're going to do it, but they never do it? Is it, and those types of things, and how I guess opportunistic is management to go after value enhancing activities versus not? And I think if you just look at the track record of some of these businesses, you can see that. And that in my mind is sort of the best way to do it, because management may have good intentions and they could convince you that that's what they're going to do, but until you actually see them in action, and COVID probably provides a good case study of this, you can sort of see what their reaction was. And the nice thing about the stuff today is there's just so much, I guess, information about companies that's not from the companies, from third-party sources, through news sources and stuff like that, that you really can get somewhat of an outsider snapshot of what's going on, whereas in the past, a lot of the stuff wouldn't be reported and that kind of stuff. So, I mean, that's some of the stuff I would try and do, like what Shree had talked about. What's management's reaction and stress? Because that's a key test of their integrity and what they're really going to do and where their, where their intentions are.
And you can pick up a lot of information by reading the proxy. And
Yep.
compensation, incentive structure, everything is listed out there. Years ago, I was invested in a small insurance company called Independence Holding. And the CEO was being paid a regular, it was $500-600 million market cap company. But right in the table, right below the table on which they list the annual compensation program, there is a small blip about how the CEO's employment agreement was redesigned in 2011. And the point was he was going to get paid 3% of the difference between purchase price and the book value of any segment that he sold. 10 years later, what do you think happened? He sold all the segments. And I mean, you could have picked this up by just reading the proxy 10, 12 years ago. And so the proxies are there for a reason, and a lot of managers don't spend enough time reading it.
Yeah, the only two hacks that I found that I don't know why they work exactly, but one is management that this is their second career. I found that to be very successful. So they had something to do with the industry, and maybe they got fired from someplace else, maybe it got bought out, they were the number 2 there, whatever. Think like a Jamie Dimon after Citigroup or something. You can judge someone like that. They're not going to be famous the same way, but you can look at what their past record was and get an idea, because they kind of think this is what went wrong last time, or this is how I could fix it. And then I can do what these other people did. I found that to be very successful. And then in terms of the proxy and those things, the one that I found to work almost all the time is if the CEO is not the highest paid person at the company. If they're willing to pay some other executive more in total compensation than the CEO, the chairman, whoever the top person is there, then that's a really big sign that there's an awareness that maybe the top guy is going to be willing to work there even if he's not paid the most, and that other people at the organization are going to be really important, and there's a recognition of that. And I found that to be a huge sign, and even a transition in their thinking about the business when they're willing to finally do that and pay someone else more. And often that's the biggest help in understanding who the successor will be, what the culture will be, all of that stuff. And at Berkshire, there's some people who are paid very highly now, and we know that from disclosures, and that's a good sign.
I mean, I would even go to state even if the top management team's paid about the same amount. I've seen some companies where, because in essence, if they're paid the same amount, and let's say the CEO gets some extra compensation, if there's an option, it's more of like a teamwork kind of thing. When you read these proxy statements, it's incredible how many times the CEO gets paid everyone else, and just think about what that's psychologically telling people. It's basically saying the CEO is worth a lot of extra money, and it's, in my mind, it really sort of strips out, okay, this guy could be a good salesman, but if he's making 10 times or 5 times the other people on the management team, how would you feel if you're in that situation, right? If you know your CEO is making 5 to 10 times your amount that you're making, I mean, in those kind of situations, a lot of us, you can just sort of say, how would you feel in that? Would you feel if the CEO, the CEO is leading the company, but if all of his excess compensation is due because the company does well, I think that's a great alignment. And the only place I've really seen, one place I've seen that is in some Canadian companies. I haven't seen many American companies where it's like that, but Canadian companies, for whatever reason, the compensation seems to be more balanced on the management team. I don't know, but I think that's a really good place to look.
All right, we'll do one more question, and then we won't compete for the bar anymore.
And our managers will be around for mingling after.
Thanks for having us here. Geoff, you mentioned regarding reading the history, go back 1,500 years and see how those sectors were doing. So is there any specific source which you use, or you just go by the books, because most of the companies are not in the business anymore, and it's really hard to find specific material on those? Thank you.
Yeah, I'm obsessed with reading books that were contemporary of the time from a long time ago on all sorts of different topics and learning about them. I've read all sorts of very strange books. I mean, I think I mentioned in something once that I read a history of the clipper ship industry. And then that's not unusual. I'm not saying that because that's unusual. I just like to read that kind of thing in any sort of business book from then. A lot of business biographies and things like that, and see what things apply now. I'm very skeptical of statistical analysis today, looking back in the past. There are some like that, like the Shaughnessy, looking at how the different sectors did, and that's valid. But what's often more important to me is getting some idea of what sort of patterns repeat. And things, I love to read things that are covering periods from 1830s and stuff, as much as I would love to read something that's covering the 1980s or the 2010s. And I think of it as just as valid, because we shouldn't assume that many of the things that we saw in the last 10 years are more likely. In some ways, the mistakes people will make may be more like ones that they haven't made for a long time. Because they're likely to not do the same things that didn't work recently, but human nature will be the same and those sorts of things. So I read a lot of books from a very long time ago, and I prefer reading books as opposed to other sources of more current media things, news articles and things, long-form stuff that's very detailed about that topic, and that's very contemporary, that people didn't know what the future would be. I love reading about what they were thinking about inflation in the 1970s when they didn't know what was going to happen in the 1990s, and I think it's a lot more valid.
Back in the day, McDonald's spent a lot of money and resources and effort trying to find the best locations to put their stores, put their restaurants, and Burger King spent none. They just built one across the street from McDonald's. So my takeaway here is Geoff is the McDonald's. I'm just going to ask him occasionally and listen to the podcast and be the Burger King.
I mean, there are some industries where there's really good history. Some industries, like for example, the shipping business, there's a lot of good shipping companies that have been around for hundreds of years. There's a lot of really good history. But like as Geoff said, I mean, I think the key thing is basically just there's a lot of information out there, and if you've got specific questions about certain areas, there's a lot of really good sort of contemporary stuff. There's different types of books. There's some books that are more narrative, and then there's ones that have more data. I have a tendency to like the ones that have more data, but it's really sort of a combination of both. Some of them don't have as much data, but it's interesting just to look at how people were thinking. And like as Geoff said, people's reactions are going to be the same. It's just a matter of some of the mechanics may be different because we've got different sort of technologies and different stuff that's happening, but a lot of the underlying mechanics are the same. There's a great book out there called The Crisis and Its Aftermath. It's about the Great Depression. And it's the Goldman Sachs partner put it together in the 1970s. He goes through year by year, goes through stock market, bond market. In the stock market, he goes through industry by industry, specifically talks about companies. So he's got this whole big volume in the front that does all that. Then he's got this appendix in the back that has all of his source material. So those are the kind of books I really like, because you could say, okay, the guy has somewhat story, but you can go back to the source material and take a look at that and then see are there any additional things you can get from that. But that's the best book I've seen in the Depression. I mean, because some of the things that may not be intuitive is that when you read the narrative and you're going through it in a timeline, what was happening back then is banks were failing. Now, for most of us, that's totally outside of our realm of possibility. But when a bank fails, you lose your entire life savings. Back then, there was no FDIC to protect anyone. So, I mean, can you imagine going through a financial? And people compare like financial crisis to the Depression. I just say, wait a minute. Could you imagine going through a depression and everybody losing their savings? What that does to you just economically and psychologically? I mean, it's devastating, right? I mean, you work really hard, you save, and then it's gone, and you can't do anything about it. I mean, it's just those types of things. When you read those books and you sort of can think through, those are the types of things I think that you can, those historical fact things, as Geoff said, that do stuff contemporaneously, I think add a lot, at least to my understanding, of what those periods of history and how those, people look for similarities, but it's also, I think, sometimes good to step back and appreciate the differences in understanding, okay, we do have a better system and why the system is the way that it is too. So it's, for me, it's had sort of multiple outputs, but I think it's definitely worth your while if that's the kind of stuff that you like doing.
Alrighty. Well, thank you so much, everybody, for coming out. And yeah, the managers are, I think we have the room till 9 o'clock, correct? So if you guys want to have side chats with them, they're available. So thank you so much, everybody, for coming.
Thank you.